Today, I'm going to be talking about how to analyze rental properties or investment properties by using the cap rate calculation. There are several factors to consider when you're analyzing or underwriting a rental property, but the cap rate is one of the most important ones. First, we're going to take a look at how to calculate the cap rate based on current income, so the current rents and expenses that a property has. And then we're going to take a look at how to calculate the projected cap rate based on the rents that you're going to get, but also how much money you have to put in order to get to that rent. After that, I'm going to be given a few other tips to keep in mind while you are underwriting the rental property that you're looking to purchase. My name is Shaynon Gramling, and I'm a real estate agent in New York City and in New Jersey. And I actually started out by selling strictly investment properties, mainly apartment buildings, mixed-use buildings where you have apartments over a store. I started doing that about 10 years ago. It was the end of 2013. So my very first experience in real estate was strictly investments and figuring out cap rates and all of that. So I'm going to be sharing that with you today. First, let's talk about what a cap rate is. Basically, it's the return that you can expect before your debt service. In order to calculate cap rates, first you take all of the income that a property is getting on a monthly basis and you multiply that by 12 in order to get your annual income on the property. Then you subtract the expenses. So you're going to take all of the monthly expenses and multiply that by 12 to get the annual. And now you have your annual gross rent and you have your annual expenses. You're going to subtract the expenses from the gross rent, and that'll give you your net operating income, or your NOI. In order to get to the cap rate, you're going to take that net operating income and divide that by the purchase price, and that'll give you your cap rate. I'll give you an example. Let's say that you're looking at an investment property that costs $1 million, and the current gross rent on it is $90,000. And then your expenses are $40,000 a year. So what you're going to do is you're going to take the $90,000, subtract the $40,000 from it, and that'll give you $50,000. So on this property, the net operating income is $50,000. Now you're going to take that, you're going to divide it by the purchase price, which is $1 million. So $50,000 divided by $1 million, that gives you 0.05, which is 5%. So your cap rate on this example would be 5%. When you're looking at a property that is completely maxed out, meaning that there's nothing more that you can do in order to boost its NOI, you'll stop there. This is a 5% cap rate property and you're done. However, if you're looking at a property with upside where you can add value to it in order to boost its income or even lower its expenses so that you can get a higher NOI, then you're going to have to do what I'm going to discuss next, which is projecting your cap rate. Basically, what you have to do is figure out what your projected rents are. What can you raise them to? And then you have to figure out how much money do you have to spend in order to get the rents there. Sometimes you might not have to spend much money in order to boost the rents. Maybe the current owner just hasn't raised rents on their tenants in many years, so you might have easy upside there. However, in many cases, you are going to have to put in money in order to boost the income. So what you're going to do is figure out what your new projected NOI is going to be once you raise the income, and then you're going to figure out how much money you have to put into it in order to get to that income. You're going to add that cost to the purchase price. Then you're going to take that new projected NOI and divide that by the price plus the cost of getting the income up to that level. And that'll give you your projected cap rate. So now in that example that I already gave you, let's say that you can add value to that deal. So your purchase price is still $1 million. We'll keep the expenses at $40,000. But let's say that you can do some renovations and boost the rents in order to get your gross rent up to $120,000 a year. So now you're looking at an NOI of $80,000 because you take the $120,000 in income that you're getting and you subtract the $40,000, so that gives you $80,000 NOI. Now, in order to get to that $120,000, maybe you have to put in $300,000 of renovations, plus broker fees, everything like that. So now your new cost basis is $1.3 million. So what you're going to do is you're going to take the $80,000 NOI, divide that by the $1.3 million, and that gives you 0.615, which calculates to a 6.15% cap rate. So now, on this same deal, you're buying it at a current 5% cap rate, but you have upside because after putting in those renovations comes out to a higher cap rate, which is 6.15. When you're looking at these deals, you want to get your cap rate as high as you can. Here are some other things to keep in mind when you are analyzing a rental property. One, with these cap rates, you want to figure out what the going cap rate is in the area that you're looking in. Cap rates are going to vary between different product types and different markets. So it's important to have someone like an experienced real estate agent who knows the market that you're looking to buy in, because then they'll be able to tell you what the average cap rates are in the area. The reason we know the going cap rates is because we're looking at the financials of recently sold properties that are similar to the one that you're buying. That information is harder to find than metrics like price per square foot. Another thing to keep in mind is that usually in a neighborhood that's more desirable or a more prime neighborhood, you'll expect to have lower cap rates than ones that are a little less desirable. Another thing is that mortgage interest rates have an effect on cap rates. Usually when interest rates are higher, cap rates are higher too, because it costs more to borrow that money. So for example, if your interest rate is 5%, in order to get a return, your cap rate has to be above 5%. So you're not going to go out looking for 3 and 4% cap rate deals. The only way that you might do this is if there is a lot of potential upside in the property where you can push that projected cap rate above 5%, well above 5%. Because remember, you're going to have to put in the work to get there. So keep that in mind. And of course, do your market research. It's important to see where prices are trending. So if you're seeing an area where prices are gradually going up or even rapidly going up, you know that you'll capture that upside. You also want to try to get a handle of vacancy rates in the area that you're looking to buy in, because you will have turnover in tenants and you want to figure out if it's going to take you a while to lease the apartment or commercial space when you have a tenant move out. So if you have a lower vacancy rate, that means that you won't have an issue getting it rented out quicker, so you have less downside there. And with a higher vacancy rate, it might take a little bit longer to lease out the spaces. And that brings me to another point. When you are analyzing a property and you're looking at the expenses, it's important to put a vacancy allowance in there. That vacancy allowance will be added as an expense because that is the time that your apartment or commercial space is vacant, where you're paying your taxes, your expenses, everything like that without getting that income from a tenant. So you want to make sure you plan for that. So that is how you use cap rates to analyze a rental property, and a few other tips. If you're looking to purchase or sell an investment property, please reach out to me. Again, my name is Shaynon Gramling, and I'm a real estate agent here in New York City and in New Jersey, and I'm always happy to help. Also, if you found this video to be helpful, please give it a thumbs up and subscribe to my channel for more videos, and I'll see you in the next one.